Welcome everyone again to another podcast. We've been doing that on a monthly basis. I think we're gonna continue doing that a little bit more, maybe bi-weekly, and even at a certain point, we're gonna do that on a weekly basis to give you a brief on the market updates, whatever is happening in the market. My name is Dominique Khoury, and definitely we have Mr. Nour Hammoury, our head of market analyst. So let's start, Nour. Shall we start with the fundamentals, the most important news that we have at the moment? What are we waiting for? And maybe you tell us a little bit about the webinar that you're gonna do straight after this one.
Yeah. Well, of course, I mean, today is another important day for the markets, because as we wait for more evidence about whether whether inflation is actually slowing down or whether also the economy is slowing down. Today, maybe I would say majority of the people doesn't understand exactly what's the GDP data that we're waiting. Today, it's not actually the GDP for Q2. It's not even the GDP for Q1. It's the second estimate for the Q1 GDP, which came in last month when they announced, because there is always, you know, three readings for each GDP. It's the initial reading, the second reading, and then the last one, or the final. So this is the revised one that we're waiting on today. And maybe the GDP itself is not that important as much as the core PCE price index for the quarter. And we are waiting for tomorrow. We have the core PCE price index also, but for the month over month and the year over year. Yeah.
I think Bilal is telling us that microphone is a bit far from you, so they cannot hear you properly.
It should be. It is right in front. But 1 second, I'll bring it closer and let me know if it's better. This is better?
Yeah, a little bit. Can you a bit more closer?
Oh, other than that,
and I have the voice at the highest from my side.
Okay, is that better now?
Yeah, much better.
Okay,
yeah,
perfect.
Cool.
Yeah.
So you're telling us about the PCE, how it's more important than any other data.
But the PCE of tomorrow. But yes,
but
the PCE of tomorrow, because today's PCE is basically the revision of the quarterly PCE, which was again it was published about a few weeks back, that showed an increase, and then basically I would say that we might actually get a revision again, and that revision might be one of the most important things. But of course, the most important one is going to be tomorrow. I would say you'll need to forget about the month over month core PCE. You have to also, you know, discard the year over year. But the most important one that you have to keep an eye on is the core PCE price index month over month, and the core PCE price index year over year, because the year over year is the one that the Federal Reserve is basically looking at the entire time. And basically, we're, you know, in the middle of whether inflation is actually going back up, or we will get more evidence that inflation is actually slowing down. On the other hand, we need to see more evidence if the economy is actually slowing down, or if the economy is still strong. So that's why if you're looking at the Fed Fund futures recently, it is still kind of every day, at least for the month of September, it is still giving you that different readings. Sometimes 55, the other week we reached for the month of September, or for September's meeting, it was almost 90%. Today, I think it's about 50%. So fundamentals in general, I think it's still gonna play a big role going forward. But at the same time, you have to understand that if we get the evidence tomorrow that inflation is still on the right track, what is going to happen is basically the market will shift from worrying about inflation to worrying about what's going to happen in growth.
Cutting the rate and the growth. So
of course, I mean,
just to add on that, let's just mention that as well. The numbers of the previous months have been revised. So March 29, we had 0.5%. They revised it to 0.3%. which is something very important, and it got priced in after that. Although the expectation was around that, was 0.4. So they pushed the market much higher than back
Here,
then.
I'm gonna change my mic just in case. I'm gonna change my mic just to put something like very quick, and keep going. I'm listening.
Yeah, no worries. So just to emphasize on the part of revising the data and what happens when we revise the data. So you don't need to care about it at the beginning. That's the most important part. All you need to care about is about the numbers that will come out at the same second. We do know that most of the data is already priced in. So whatever we can see in the market at the moment, it's already priced in. So the market understands that, okay, we are on a better way at the moment. The economy is doing a little bit better. We are controlling the inflation so far somehow. The decision of not cutting the rates soon is something that is already priced in the market. As we were discussing actually 2 days back, we have 85% rate cuts in September that dropped to 55%. So the expectation on the market dropped to do any action from the Fed in September. Because of that, you need to understand that any data that comes from the PCE, the same as expected, you will trade that data exactly. You don't have to think about the revision of the numbers or whatever happens after that. This is the most important part. And you do the hit and run thing, the same thing as we do always. After that, we wait for any revision that will happen. It will take impact, and it will do an impact on the market on a later stage, and we can take advantage of that one as well. That's regarding the data that we have at the moment. What do you think about the ECB cutting rates before the Fed, which is something that we were discussing with Hafid yesterday?
Here's the thing. First, the mic is better, I think.
Yeah, much better.
Okay, that's great. About the ECB, I think they're even if they start cutting rates, I think it might be a hawkish cut. I don't know if that happened before. A hawkish cut, meaning they might actually be ahead of the Federal Reserve when they're going to be the first to cut rates. But does it mean it's going to be scheduled? Meaning, is it going to be the first cut, and then we have a plan at the next meeting to cut another 25 basis point, or another meeting, another 25 basis point? That I doubt. Even if the ECB decided to cut rates before the Fed, which was one of the reasons why basically the euro also went down last I think since yesterday, is basically one of the members of the Federal Reserve first said, I don't think that that we eliminate the idea that we will not raise interest rates. On the other hand, one of the ECB members said, we basically should not exclude cutting rates in July. So one side saying we might actually still raise rates. The other side is saying we should not exclude rate cuts also in July. So I think in both ways, especially after what we saw from inflation data over the past few days. I mean, yesterday's German inflation data was not showing any sort of like a huge slowing down. It's still sticky. It's very sticky, and I think it's more sticky than the US. So even if they cut, one of the reasons I think that the euro is still holding is basically investors knows that the ECB might not be able to cut as fast as the Fed, even if they do actually cut before the Fed. But the data today, yesterday, and this week is not actually kind of supporting the idea of even a 25 basis point rate cut by the ECB. But if it happens, I would still say it's going to be a hawkish cut, meaning they're going to cut and then they'll have to wait. They'll have to wait again, because we have more evidence in the US that inflation is still on the right track than in Europe, and it's more sticky than in the US.
Yeah, the last meeting that they had, Powell and the representative of the ECB, they discussed that in details. I think it was last month, and they explained the factors and what they did, or the difference that happened between Europe and how Europe handled Corona and injecting money, and the same comparison what's happened in the US. So we've seen in the US checks, and we've seen a lot of support, but in Europe we've been paying the same salaries. In the US we had let goes for the work. People shifted from a company to another. There was some shuffling in the market, which was a bit healthy. Eventually, or at least now we're noticing that's a bit healthy compared to whatever happened in Europe. In Europe, they kept their work. The government kept on paying, which created a very high cost for them, despite the fact that it's a more aging country. So that's something that affected as well. Let's say the recovery of the market. But despite all that, if we take a look at the chart, if we want to take a look at the technical part of the euro dollar, we did break. We're still on the trend down, on the major big trend down, but I mean we did break the support line that we have on the daily chart. So now we did break that resistance that was back then at 108.30 or something like that. We broke that, traded all the way up until 109 or 108.90, and then now we're retesting the same support line that we broke before, but we're still above it. We did not close below that. I think if we close below the 108, that would on the daily chart, I'm saying, if we close below that would be a bit more indication, technically speaking, to continue going down at least for another 60, 70 pips from where we are at the moment.
Yeah, I think, I mean, if you look again, just like you just said, it's easy to watch on the chart how the euro has been very resilient for the past few months. And at the same time, I mean, I know at some point, or it is basically kind of boring recently, at least in the currency market, because if you open the chart, we're still within the same trading range since about like a year and a half. The dollar index between 107 to 100, the euro between 107 or 106 to 109. But the same thing goes like to multiple other currencies, except of course the yen, which is kind of highly volatile recently because of multiple of the interventions by the Bank of Japan. But the euro itself, I think, as long as we keep holding this 107, 107.50, here's one thing, despite the fact that they might actually cut interest rates, one of the reasons why the euro has been weakened recently is basically pricing in that the ECB will be cutting rates. But the fact that the euro was able to hold all this time is basically telling us at least that there is still some strength in the euro. On the other hand, the dollar might not be actually as strong as the euro in the next few months, as they continue to or as they will hopefully, or maybe they will actually start cutting rates. So that's why the market has been boring, because the expectations keep shifting. At the beginning of the year, remember how many markets were basically talking about 6 rate cuts by the Federal Reserve, and then that went down from 6 to 5 to 4 to 3. Now, according to the Fed Funds futures today, if you see, it's basically 2.5. Goldman Sachs the other day came out and said like the Federal Reserve might not even cut rates this year. If this is true, if the Federal Reserve is not going to cut rates, this is when you would think, okay, the euro might actually break below 107. We might even go back even low towards 103. But this is contingent. If the Federal Reserve basically said we're not going to do anything and we'll just have to hold our grounds. On the other hand, if the ECB basically cut, so the difference or the rates differential always plays a huge role when it comes to currency market.
Yeah, but despite that, I agree with you with what you're saying. But for us as daily traders and for the traders that we have at Squared, eventually the analysis of daily chart, 4 hours chart, or whatever is happening, this is something that we can still benefit from.
Oh,
On the long
100%.
run, or if you're doing like an investment, not just trading, or you're not speculating the market, okay, that makes more sense. That definitely we are still ranging since the beginning of the year. The market barely moved a couple of hundreds of pips up or down on most of the pairs, which is in my opinion something that is really beneficial for us.
Yes, it's
I was
definitely
able to
not a
take
bad thing.
advantage of a lot of things in the market, to be honest. It's like an easy market nowadays. It's not the same as back then, where in Corona times you could see that huge candle that can destroy anyone and breaking multiple resistance or multiple supports in the same day. Nowadays, it's a bit easier. We are literally respecting the support, the resistance, the weekly trends. All of these are things that we need to take into consideration while we want to take a decision when to enter and when to exit on the market. So, for example, the bounce back that we had today, that easy bounce back from the support of 108 that we were discussing, or 107.90. So this is an easy trade. This is something that anyone could have taken advantage of. The market did not break below the trend line, and we just applied the rule of 4 trades within the channel, or if we break. So 2 trades within and 2 trades if we break the channel. Very easy strategy, like the basic strategy that anyone can ever understand. And if we have between us some traders that would like to understand a little bit more about the market, and they do not have any experience in that, we're doing workshops as well. You can come and visit us in Dubai at our offices and attend those workshops. They're free. We offer them to our clients exclusively. And of course, the webinars that Nour and I, we constantly do. So we have at least, I don't know, every week we have 2-3 webinars that we keep you updated. You'll be able to confirm and reconfirm your strategy if it's compatible with the market. So, for example, what we're discussing now on the euro, can let's give some supports and resistance on that, Nour.
On the euro?
Yeah, on the euro. So the resistance for this week, it's still the same, 108.90. Still holding the same level, I believe. Yeah, 108.90. That's the major one for this week. And the support, the one that we touched today, definitely there are other supports below it.
107.87, and you have also 107.70, which basically it comes with a confluence also with the 50
moving average 50
days moving average. Yes, that's another thing.
SMA,
that's for sure. So, and at the same time, if you look at the chart, there's also like a what is it called? A bull flag on the daily. Contingent that we actually break above the 108.60 that we saw yesterday, and to keep basically, of course, hold the lows of today, including the 50-day moving average that's still holding. There's also the 100. I'm not sure if it's up. Yeah, no, the 200-day moving average is also still holding, and now we're currently above the 3 moving average. So as long as this continues, that's going to be that is still keeps the the bullish outlook at least unchanged for the time being.
Yeah, the 100 is already broken, and the 50 we're still trading above it, and the 100 as well. So these are the supports and resistance for the euro. You can trade in between. Make sure that you always put a stop loss and take profit on your trades to manage the risk and survive the market. There's a lot of opportunities that we're going to discuss today, and a lot of things that you can benefit from. Other market updates. If you guys, as I was saying, if you guys would like us to discuss any product, please let us know, or mention it here so we can discuss it. Definitely, we're gonna talk about the famous gold and silver, but we mentioned briefly an update regarding the dollar index. I would like to talk a little bit about this. And if you take a look at the chart of the dollar index and how we're trading and how we've been trading lately, you've been noticing that any correction that we can see in the market is well supported, and it's not breaking the major support line. We still did not close below the 104.
There we go.
Let me just update
Sorry.
sorry. Yeah, you're back.
Yeah, something happened. I don't know what is it. But yeah.
Welcome back.
Yeah.
So I was talking
going.
about the dollar index if you couldn't hear us before.
Yeah, I was hearing.
So what I was saying is, despite all the correction that's been happening in the market, and despite all the news and the data that we've been getting, the support line of the dollar index, we're talking the support line connecting 28 December to 8 March, the same support line connecting 16 of May, the same support line that is moving up every time from 104 to 104.35 is very well respected, and we can see that investors and traders are pushing the market up every single time. Although what we can notice is that the size of the candle is not the same anymore. So from the psychology of the candlestick, this is something very important, that the volume and the strength and the momentum is not as strong as it was before. So there is a very decent resistance as well at 105.20 or 105. That level is not breaking as well. So we're still trading between 104 and 105, 105.20. And we're kind of like stuck here to wait and see what's going to happen in the next breakout. As Nour mentioned, despite when we were comparing the euro and the dollar, the problem is the dollar, if it breaks from here, we're going to see a much bigger impact. We're going to see a much bigger fall because the volume traded on the dollar is much higher as well. So we're going to have a lot of stops, and it affects a lot of currencies at the same time. So that's something to always take into consideration. Now we have some correction going back to the support line again, but still the major trend is still up until this moment for the dollar. How does that affect, before moving to gold and silver, Nour, how does that affect the stocks and the indices? Because we've been seeing from the market, the indices are going up like crazy, right? And they're very well supported. Despite that, in the past couple of days, yes, we did a correction. That's right.
That's
doing
that's
the Dow
a
Jones
normal
40K. Yeah, it's normal. We've done 1,200 or 1,000 or 2,000 pip correction. That's fine. But the trend is still the same. If we take a look at Nasdaq, it's in a much better shape than the Dow Jones. The S&P as well as a much better shape than Dow Jones at the same time. Can you just briefly tell us why Dow Jones is getting affected much more than Nasdaq and S&P? That's one. And second, the correlation between the dollar index and the indices, the US indices.
Here's the thing. I mean, for the past few days, the majority of the move that you basically saw in stocks was more correlated with what is happening in the bond market more than what is happening in the currency market. Yesterday we had some other data that includes the consumer confidence, which was much better than expected. We had the housing data, better than expected, which again kept the market kind of like guessing. Is the market or is the economy still very strong to keep interest rates higher? That is basically what the market or what the data showed. In return, basically yields went back up all the way. Again, 10-year yields, at least for the time being, 10-year yields about 4.5. You had also the 20 years, the 30 years also. Despite that, that's basically one of the main reasons why we've seen this correction. Why Nasdaq is better than the others is basically because of what's happening in Nvidia and most of the tech companies, because it looks like that AI or the earnings for the last quarter, AI basically showed kind of a clear sign and a clear proof that using AI is actually or companies were able to generate new income stream using AI. It is good and bad at the same time, because I don't know if you heard, Morgan Stanley was trying to implement AI into the sales desk, and they were basically able to, or the AI that they built, it can basically replace 90% of the people in that department, which is again good and bad at the same time. But who knows how they're going to basically monetize it in the next few months or in the next few years. So this is why Nasdaq basically is still better than, or at least in a better shape than the others. S&P, Dow Jones, I think even with the decline that we saw, I still believe maybe until June 10th of June, or maybe until 10th, between 10th and the 13th. This is maybe might be the end, or not the end. This is when I think the market is going to actually basically start turning lower again. But now we're not talking about any kind of huge declines. We're talking about just basically a normal retracement to the downside, might be between 5 to 7%. And my camera is gone again.
Yeah. So actually, I wanted to discuss something that you just mentioned before we continue. Or actually, you already answered the question, but you mentioned the Morgan Stanley replacing the sales department with
an AI.
with AI, which is something. No, don't get me wrong. I'm not pointing at that, but this is something. This is a discussion that we've been having, and every single time we have a couple of analysts or a couple of traders or any group, and we start discussing what are we going to do in the future? How will that affect our children's, our investment? Should we shift a bigger percentage of our portfolio to tech or not? Is this going to be a bubble, or what's going to happen later on? From a small experience that we've been having, or we've seen here, let's say in UAE or in Dubai in particular, have you noticed the banks that applied the AI on the answering machines, and they tried to replace most of the call centers and that service? I don't believe, okay, it did reduce maybe the number of employees and the cost for the bank, but at the same time, service-wise, I don't believe we got a better service. That's something that the human touch cannot be replaced in that part. There are
I think it's going to take time.
Yeah, exactly. And we need to develop even the way we are treated, or the way we get the answer and the question, how it's asked. Even nowadays, when you use ChatGPT or any platform, you notice that sometimes you ask a certain question, or you put a certain article to be analyzed or discussed or whatever it is. It's not being understood the same way that you would like to put it. So you need to rephrase it a couple of times to get what you need. The same thing, imagine if you are a customer in a bank and you'd like to withdraw, or you have a problem on your credit card, or you have a problem on whatever. It's not easy to replace someone that can act promptly and take this into consideration and see and feel how important is the issue in front of us. So I think we still need a lot of development in that field to be replaced until now.
I lost you for a second.
Yeah, so we finished the discussion regarding the AI and
oh yeah, gotcha. Okay.
the development on that part. So that's what's supporting Nasdaq and S&P at the moment. That's why they are better off. You mentioned that the yield is the main factor affecting the indices at the moment. We need to mention that there is major support that we are coming near through on Dow Jones, around 37,700. It's a support zone, actually. It's not a support line. So between 37,600, 625, all the way until 37,800. That's the next support zone over there. We've already passed the idea of correction on the short wave because we already crossed FIBO. And now we kind of like doing like a reversal on the trend up. On the again, I repeat, it's on the short wave, not on the big wave. So
No,
you
not
guys
on the
keep
big
that in
outlook.
mind. Yeah, exactly. So just on the short term for the daily traders, for the ones that took advantage of the breakout of 3,900, of 39,000 actually. The one that took advantage of that breakout, I think they kind of are preparing themselves to take their profits at these levels here where we are, or maybe a few pips later, or a few pips lower from here, because
sorry, keep
usually
going.
we see
keep going.
yeah, because usually we see a lot of support, especially from the US or the US indices. Every time it drops for 2,000 pip or 1,500 pip, we see that the buyers will come and then pick it up and push the market up again. So that's something that you guys need to keep in mind, especially the ones that have that conspiracy idea where the market is going to crash from here. We're going to see the same effect as in 2007, 2008.
Here's the one thing about this conspiracy. If you open any chart, include especially stocks, indices, whatever that is, if you count how many times the people were waiting on a crash and compare it, instead of them expecting a crash, and if they've done the opposite on each and every single decline, I don't know, you'll be able to count, it's countless times how many times people think the market's going to crash, and it's very few times when the people believes that the market's going to go up, and it's almost always at the end that they start buying again late, and they start basically selling also either early or also late, but at the same time, this is what has been happening. One thing that I would say about this one, if people understand one thing, stocks in general, or especially stocks, or any assets that's basically introduced in the market, their core structure is to go up. That's why they have it in the market. This is why they actually introduce stocks. Is basically stocks goes up by nature. This is the core structure of it. They're not going to basically, or they're not introducing any kind of like type of assets for this assets to go down. It is basically introduced to go up. So if you count how many times that you bought compared to how many times you sold, you'll feel like, okay, well, I should not even think about shorting. I would wait for retracement in order to go back in. Some people would say, yeah, but it's too much high. We should have bought about like a year and a half ago or 2 years ago. It doesn't matter. Look into it in the different way, that each and every single correction might last for how long? 3 months, 6 months, a year. Consider it as an actual discount, as if you're going on sale or shopping. You would see, let's say, anything, a phone, whatever, they tell you that, oh, it's 50% off, but it's actually not. But for the stock, when it says, yeah, the stock market goes down by 30%, that's an actual and a very genuine time, or very genuine correction or sale, in order for you to go shopping. So instead of go shopping, buying a phone, maybe go shopping for stocks.
Yeah, that's actually calculated, and if you just take the example of any, if you want to take an example of the phones, any phone, just buy the stock of the same company producing that phone and see what would have happened from a year till now, or from 2 years until now. That would have made a huge difference in your portfolio. I just want to answer, I think Ayman and Bilal,
I saw Bilal
they were saying,
posting something.
Yeah. So they were saying that the AI is the new era, and it's getting better and better. So I totally agree with you. Yes, it is getting better, and every time we move in time, we agree that this is the future. We're not saying it's not the future, but what I'm saying, until this moment, we're still not there yet. So the belief and the view of the AI is still not well explained and well believed in from every single type of person, of people, of human around the world. So we're still not there yet. That's what was my idea at the beginning. But I do agree.
It's going to take some time.
This is the future.
Still.
Yeah.
As you said,
it will take some time. Yeah.
But you can't basically still count on it. But at the same time, you can still use it. At least when it comes to the other day, I was on Al-Khoury TV. They were asking about trading bots, and I was like, well, the trading bots have been there like for a long time now. But does it mean it's different this time? Could be, but it depends if that AI that you create to be able to get live data feed, and not just live data feed as live numbers or live data when it comes to prices, but live data when it comes to news, and how the AI is going to be able to understand this news and reflect it on its trading strategy. And always remember, the AI will never do, at least when it comes to trading, it won't do something that you did not train the AI to do. Yeah, because when you do train it, when you do train an AI, it will be trained based on the data that you give it. But at the same time, you can give the AI the chart from 1920 until today and start training the AI how to take a decision. But you can't get basically all the headlines that affected S&P 500, excuse me, since 1920 until today, in order for the AI to understand if this is a good number, bad number, especially that at some point, there was some data that was actually positive, but the effect on the market was negative, and vice versa. So it is going to be very challenging still for AI to have like an actual sustainable trading bots or trading AI. It's going to take I think it's going to take years until this is developed before we can actually get an actual AI that can actually beat the market.
Yeah, well, but that's a subject that basically you cannot deny the fact that technology is something that we are obliged to use nowadays, and even in trading. If you have a certain strategy and you'd like to trade it, if you notice that if you build a bot, or if you build an expert advisor, the results that you will get are much better, because eventually you've built
I got the live alarm. That's why.
You got what?
There's a fire alarm in the building. So I'll be here for a second. I'm here, but I have to mute just the microphone.
Touch the floor like Joey, see if it's still hot. We still got time.
What is going on today? Run.
Okay.
I don't know. Yeah, that was probably a fake one. But the the speaker is literally right up on top of me, so that's why it was too loud. All right, keep going.
No, actually, we didn't hear it. From our side, we did not hear it.
Oh, that's good.
Yeah. So we got some comments actually.
Run the stairs and come back.
Usually they do a lot of tests here. That's why.
I'm on the 28th. I'm on the 28th. It's not that bad. Not that bad.
You can still jump.
Ayman was asking which floor. 28th.
Yeah.
That's better than the previous one. One of the years I was on the 48th, and that was not fun.
Yeah.
Evacuate. All right. So can we? We have what? We have about maybe like 10 more minutes.
Okay.
Do you want to talk about gold?
Yeah, let's jump to the market. Before gold, there was a request for Aussie dollar.
Yeah.
Okay, so we don't miss any requests.
All right. Here's the thing. But definitely in our next session, we will have it in a different way. We'll be able to share charts with you guys. It will be basically more clear for everybody to be able to understand what we were talking about with charts. But I think Aussie Kiwi when it comes to, whatever happened because they're commodities related currencies. They have been holding also over the past few weeks multi-years low. That includes at least in Aussie or also in Kiwi. Even for the past few days, we kind of have currently, if you look at most of the currencies, we have a bull flag on most currencies, and on the other hand, you have a bear flag on the daily chart on the dollar index. So this basically, you just need at the same time, you just need basically the catalyst for these bull flags and bear flag in the dollar index to be confirmed. Such confirmation might come in through I don't know. It might be through the GDP data that we're waiting today, or the core PCE that we're waiting for tomorrow. That would be one of them. But long term, most of the banks, I would say, are expecting a weaker dollar until they actually start cutting rates. This is when the shifting in outlook might actually change. And we lost the camera again. I have no idea what's going on today. But did I answer the question? And we got disconnected again?
Again, yeah.
What is going on today?
We've been targeted, man.
All right. Did you, what was the last time that you heard?
Just 2 seconds back. So you were correlating between the dollar index bearish and most of the other currencies that are bullish, and the data that we're waiting for is basically it can be the current events that we have this week, and it can be something else that we might have maybe next week, or any decision that comes from the Fed or whatever meeting that we have. Just to add one more thing actually on the Aussie question, we can notice that on the weekly chart, I don't think this week is going to be very relevant unless we break the 66.80, or even if we break the 65.90. If we don't break, if we still trade in between, this is something that it's kind of like useless for someone that is waiting to ride a new trend, or waiting for a breakout, because we're still below the moving average 100, between moving average 100 and 50. So it's not something that is really attractive until this second, at least. On the daily chart, we can still always play around a little bit more. For daily traders, the support line that we hit around the 66 is something really, really good for entries with a very tiny stop loss. I think people already took advantage of that pull back up. It's just a couple of 20, 30 pip, which is quite good actually to trade with, at least. But let's talk a little bit about gold before we miss the time, and silver as well, because silver is being used as well in the new tech, and it's been used a lot, and that's something that I think it doesn't relate a lot. It's not something that is going to change the whole face of silver, but I think the bullish traders are using that as a reason to buy silver. I believe it's silver took a lot of time to start acting till a certain degree, where we started getting bored from the position, but at least it's starting to pay off now, finally, after a long time holding the position. So gold has been supported in the levels where we are at the moment. We still did not break the 2320. We tried multiple times. We bounced back from that, and we're seeing it supported once again. It keeps on trying. That's for sure. But until this second, there is no confirmation that we have a close below the 2320, 2325, around these levels. I believe if we break and we have a close this week below, this month might take us to retest the 2300 again. If we break again, if There is a big if over there, but keep in mind that every time we have a pullback to a psychological level or a very strong support around the 2300, it gets well supported, and the next support after that would be the 2280. Nour, do you agree on the levels? Do you think that it will get supported around these levels? Or are we gonna drop from here, or are you bullish on gold nowadays?
Here's the thing. One thing that I'm a little bit concerned about when it comes to gold is basically people are now calling for, they want to see gold over new, what is it called?
New high.
A new record high. I mean, we're not far away from record high anyway. Okay, it's not something. There is not something bad. And here I have
$100.
the backup camera.
$120. Yeah.
Yeah. So I think there's a lot of people like ask, that might be record high, whether we're going to go back to record high. Record high is only just $100 away. That is not a big deal. That's one thing. Is it going to be easy for gold to go back to record high? Yeah, I don't think so. It's going to be that hard. At the same time, you have to understand, like, whenever so far retail we did not saw retail buying gold. Who's buying gold? If you open a chart, and I hope that you'll be able to do that, but I did share it on social media at some point. Look at Russia's gold reserves and look at gold price. It's almost 1-to-1, almost 1-to-1. But if you look at the chart of the latest known gold ETFs holdings, it is still going down. So who's buying actually gold is basically, the central banks, including Turkey, including India, Russia, China, and the others.
Right.
So this is why basically gold is still pushing up, and we might actually continue with that for a while. But this doesn't mean that gold might actually go to 3,000 or 4,000 or 5,000, because there's a lot of people talking about like 10,000. Yes, it might go within 30 years. Yes, but the question would be, it's a matter of time until we go back to record high. The question is, where would you buy? And how much would you buy, and where is your stop loss should be? And I think, especially now, after the rally that we saw in gold, I would be more interested in silver, cautious, and I'll be more interested in silver than being interested in gold, at least for the time being.
So do you think the silver we might see something like euro and cable? So we might see the silver going up and gold maintaining the certain level, or not going up at the same time? Is that what you're saying?
I see. I wouldn't be surprised. I would say so. I mean, I would say there's still a possibility that you will have like this kind of disconnection, because this disconnect actually happened yesterday, and since the beginning of the week. If you look at gold, since the beginning of the week, gold basically recovered about maybe only 0.25% of a 7% decline, while silver yesterday recovered 90% of last week's decline. Silver was up about like 4% since the beginning of the week, while gold was down. So there is a disconnection. Disconnection is already there. The question remains for how long this disconnection is gonna stay. But I think silver, as long as we're above the $30, there's more chance that we will get to 34 and even 40. I would say maybe by the end of the year, more than so the upside is still more likely than the downside.
Yeah. Yeah, well, and regarding Goldman Sachs, JP Morgan, and Morgan Stanley expectation of gold hitting 2,700, they raised it from 2,500 to 2,700 this year. It's still unchanged until this second. They did not change their forecast. They only increased it once. We're talking a few weeks back, but they did not lower it back again until now. So I believe in the current market conditions, as we mentioned before, and we mentioned several times, just make sure that with the current market decision, make sure that you always hit and run, take as much from the market, and do not stay for a long time in it. Despite if you're trading stocks, you're trading gold, you're trading currencies, the opportunities that we have in the market are really nice, but at the same time, you cannot keep them. That's a problem. You cannot control them. It's like we cannot say that example, but okay, well, that's why that's why you should just hit and run. That's it. Don't do anything else.
No, not that example.
Yeah,
not that example, but yes, yeah, as you said, I mean, hit and run is still good. I mean, I prefer more of a swing approach, but at the same time, I mean, hit and run is not a bad idea. Here we have Bilal. Please, I wish you
yes,
in
exactly.
one
I was
of your
reading
podcasts.
that.
Oh, I already did that. Okay, yeah. I mean, we can definitely do that.
Let's do Bitcoin quickly.
Bitcoin,
even in 1 minute.
I think Bitcoin started a new wave, and I think as long as we're above the 65,000, we're good to go. And the next move could be maybe, possibly, that it could be the beginning towards the 100,000. And again, the 100,000 for Bitcoin, what I would say, 100,000 is basically a matter of time. Now, all what you have to do is basically control your risk and where you buy, how much you're buying, and how much can you hold until it goes to 100,000. As simple
because
as this.
The waves are big.
But as simple as this, we can say it's simple, but it's not simple when it comes to whenever you start buying or whenever the markets start going against you.
And Ethereum is very interesting at the same time. Make sure that you diversify the portfolio if you want to trade cryptos. It's toppish. It's at the top on the weekly chart. We are really near to make a new high for Ethereum. So that's something that that would be like a nice breakout, and a lot of orders will be above that level.
Totally agree.
Bitcoin volume is still pushing up as well, and we can see there's a cross on the daily chart as well on the moving averages that is getting built at the moment, but is not confirmed yet. So let's wait and see. I think in the next couple of days everything would be much clearer, especially after the next 2 days, what's going to happen to the US and the decision that will be taken.
Yeah. Keep an eye on tomorrow's core PCE, and if you have any more questions, you can join me in about like a few minutes. I'm gonna have to head to the other webinar because it's going to be. We'll follow about the data just in about in about a few minutes. So join us there.
All right, and we're doing at the same time Arabic webinars as well. You can join them from the same link, same website. Go and check them out, and we'll do more podcasts like this. It's going to be much shorter, but much more efficient, directly straight to the point, and we share the charts with you. I think Ayman is asking you, when can we join the webinar? I think just
now,
in the next 2 minutes. Just join the webinar now.
I'll open it in a few minutes.
We're not going to hold you, Nour.
Alrighty. Well, because we have to close this one to open the other one.
Yeah. Thank you guys for attending.
All right.
And
thank you so much, guys.
We'll see you the next time.
See you.
Thank you. Bye-bye.